I'm Eric, Nearing with Keystone Mortgage. I've been in the business for a few years. I'm qualified to help give advice with mortgages because I do the right thing for my client, even when it's not convenient, even when people don't like to hear the truth, I tell it to them. So a conventional loan is typically going to be sold to Fannie Mae or Freddie Mac. So 97% plus of all mortgages are either conventional or government. So if you're a conventional loan, it's gonna 97+% of the time, it's gonna end up, regardless of who you talk to or what they say, it's gonna end up in some way, shape, or form delegated to Fannie Mae or Freddie Mac. Conventional loan usually can require anywhere between 3% and 20% down or more, just depending on the individual situation, circumstance. It depends. Credit is much more important than the down payment. Typically, you'll see a jump when you go to 20%, 25%, 35%. That's usually where you'll see the breaks in pricing. Other than that, it's mainly based off of credit score.
And sort of what is the typical, maybe minimum credit score you can have for a conventional?
Excellent question. So right now, coronavirus times, you're gonna have a 640 minimum. 640 does not guarantee you will get approved for a conventional financing. So you want to double check with your loan officer to make sure you can get the approval. So there's a lot of different ways you can set this up, okay? So instead of giving you like a blank number, what I'll say is, whoever you're talking to, make sure the benefit exceeds the cost in a reasonable amount of time, right? So people can buy out mortgage insurance, they can pay discount points and buy down the rate, they can do what's called a split PMI, where you do like a lower mortgage insurance if you're putting less than 20% down. There's Home Ready, there's Home Possible. Basically, the short version of the long story for all of that is make sure the benefit exceeds the cost within a specific time frame, right? So the average time people are in homes is about 5 years, okay? So if you're gonna spend $10,000 to save $100 a month, it's gonna take you a few years before the benefit would exceed the cost, okay? So what I look for specifically for me, for my clients, if the benefit exceeds the cost within 24 months and you don't plan on moving next year or this year again, then I think it's a slam dunk and you should absolutely do it. If it's within 4 years and you wanna do it, I'll do it. If it's over 4 years, I will actively tell you it's a bad idea. And that's gonna be contrary to a lot of loan officers, but I know how long people are actually in houses, regardless of what their intentions are, because everything's so fluid, right? So why do people buy and sell homes? Marriage, divorce, babies, parents, jobs, right? Those things happen in every economy. And today we live in a world that's much more fluid than your parents or your grandparents or your great-grandparents. So very rare is the person that's in their home for 30 years. PMI stands for private mortgage insurance, okay? And that's gonna be required if you have less than 20% down. On conventional deals, if you have less than 20% down, you're gonna have mortgage insurance. Mortgage insurance is gonna be a function of the loan type, because there are several types of conventional mortgages. There's regular conventional, there's Home Ready, and there's Home Possible, okay? So it's gonna be a function of the actual type that you choose, the down payment, and your interest rate, right? If you have it's not interest rate, I'm sorry, and your credit score, right? So if you have awesome credit and you can put 3% down, I would do it always, right? And you're not gonna save as much on PMI as you might think. So make sure and talk to your loan officer. Talk to me, like I'll explain to you and walk you through that, the benefit versus the cost, because I think that's so critically important and so many people overlook it because they're like, yay, I've got a low rate. How much are you paying for that rate? So Home Possible and Home Ready are income restricted products, and it changes based upon the home you choose. So typically, if I'm talking to a client and they're shopping for a home, I'm not gonna say I'm gonna do Home Potty or Home Possible or Home Ready. I'm gonna know that they're eligible for it or not. And when they find the house, then I'll determine if that house is eligible for it, right? I don't want people to restrict their search necessarily for those products to save 15, 20 bucks whatever the case might be, right? You're gonna save a little bit more money on Home Possible or Home Ready than you would on straight conventional if you qualify for it, but it's income restricted, and that can be a little tricky. So you wanna make sure that your loan officer knows what they're doing.
You have any idea what the income restriction is?
It depends on the house. So like when you look up, so if you pull up a map or whatever, you can go to Fannie Mae or Freddie Mac's website and actually pull up the lookup tool or whatever, and it'll tell you if you put in a specific address what the income limit is. So the buyer that the conventional loan is best for, right? So there's so many different things that you can do. So what I look at when I'm evaluating is what's gonna save the person the most money on their monthly payment and in their bank account, right? So I look at all of the options and I will help them figure out which one's best. That's it, right? You just need somebody who's honest and is gonna tell you the truth and be able to help you discern between the loan products, right? Some people will push you to an FHA where it doesn't make any sense, right? VA almost always makes sense, okay? Almost always. If you're a veteran, you should do that, okay? On conventional, if it's gonna save you money on your down payment and on your monthly bill, then you should do that every time. I mean, like just being real, like my biggest thing to tell people is if you have somebody you can trust, they can help you discern between what's best and what's not. Your mom, your grandfather, your friends, your neighbors oftentimes might have the best intentions, but you always want to go to the person that has the most knowledge and has your best intentions at heart. Does that make sense? But it's the same with real estate, right? You don't want to go, like, just because your neighbor used Susan Bob doesn't mean that you should, right? You need to go to somebody that knows what they're doing and is going to look out for your best interest, period.